But is there anything we can do to protect our portfolios from the next black swan event? Sean Teo, Senior Research Analyst with IFAS Financial Singapore, is here with some answers. Welcome, Sean.
I'll begin sharing my screen now. Thank you for having me, everyone. My name is Sean. I'm from the IFAS Unit Trust Research Team in Singapore. And today I'll be sharing with you some ideas as to how you may actually prepare your portfolios for the next Black Swan events. So the thing about Black Swan events is that actually it's a term that came from the past, right? Because people were less educated. And I think the Europeans were the ones who realized that, hey, I think it's pretty much impossible to find a black swan because it's something that they've never seen. But little did they know that, actually black swans are very, they can be found very readily in Australia, right? So I think the whole idea of the Black Swan event, the idea of it is that it was came up with by Nassim Taleb. He's an author. He basically theorized that Black Swan events are basically financial market events that happen very infrequently, but they are often the catalyst for severe losses in market. So I think over the last few decades, we have gone through quite a fair bit of Black Swan events. And before we actually go through the list, of course, Black Swan events are something that we cannot actually predict, because if we did predicted it, then it would not have happened. So some of the examples of Black Swan events that have occurred over the last few decades, over the last 4 decades. Of course, this list is not all encompassing, but I guess it gives you an idea of what Black Swan events are. So all the way from 1973, we had the Israeli and Arabian War. And also, I think we had SARS as well in 2003. We also considered it as a Black Swan event. And the GFC, some people may have claimed to see it coming, but as a whole, the world did not see it coming. And last but not least, I think the most recent one is the COVID-19. So I think the biggest thing that I think you can observe is that, there's no rule of thumb when it comes to Black Swan events, right? In terms of sell-off, they differ very wildly. In terms of the duration, they also differ quite wildly. The GFC lasted about an entire year, but in terms of sell-off, but I think when you look at just the COVID-19, I think just within a month, we recovered pretty much. We basically had a trough in financial markets just 1 month later. So Black Swan events, they have there's no real characteristics to them except that they are very damaging in terms of financial impact. So I would like to share with you some ideas as to how you can survive a Black Swan event. And of course, these are things that you may already know, but I think they cannot be emphasized any further, because I think people at times do take it for granted in terms of looking at these things. And I'll show you how just by themselves, they can actually diversify and improve your portfolio from a risk-adjusted perspective. But I think the really key point I will make at the end of my presentation is really that these 3 keys really help you psychologically, help your clients psychologically when investing in the markets long-term. So the first thing as to why you should really think about preparing yourself for the next Black Swan event, aside from the financial impact. But really, I think from a portfolio perspective, the odds are always against the investor, right? And I would argue that actually avoiding drawdowns is actually more important than chasing returns, because of the fact that your portfolio has to work harder for every dollar it loses. So this chart, I think, shows this idea very clearly. So on your x-axis, you have your loss of the loss of capital, and on your y-axis is basically how much you have to gain for every loss of capital that you have. So for example, if you lost 25% of your capital, you would need to generate a return of 33.3%. So the more you lose, the odds continue to stack more against you. So when it comes to diversification, I believe some of the presenters earlier, they have already shared with you some of these ideas when it comes to inter-asset allocation, intra-asset allocation. Of course, just to recap, inter-asset allocation is basically diversification across asset classes. Equity, fixed income, alternative investments, gold, these are what I would consider inter-asset allocation. On the other hand, intra-asset allocation are basically within the equity segment, within the fixed income segment. How else can I further diversify my portfolio? And that's where your equity segments come to play, fixed income segments come to play, your geography comes into play. And I think from a portfolio perspective, the reason why you want to diversify is because most of us would definitely be invested in equities, and they are the key source of portfolio risk for us. So the idea is to actually, from an inter-asset allocation perspective, intra-asset allocation perspective, to pick investments that have the least correlation to equity risk. So what would it be like to be investing out of Indian equity markets in terms of like diversification, right? So this is basically a table stating over the last 10 years what the various correlation the Sensex index has with other global equity markets like your S&P 500, your Nasdaq 100, or your stocks, your European 600 index. And what we have found is that actually global equities move very differently from Indian equities. So by investing in global equities, by having some portion of a portfolio in global equities, right, you immediately get diversification benefits as seen from all these numbers, all these very low correlation numbers over here. So on a monthly, whether or not you compare it on a monthly return basis, quarterly return basis, semi-annual return basis, or even annual return basis, what we find that is that these global equities generally have a low correlation with Indian equities. And of course, this is from a rupee perspective. So by actually considering investing in global equities, it actually adds to your overall portfolio resiliency because, when Indian markets go down, it's unlikely that global equities as a whole would go down in the same magnitude as Indian equities. And I think another key reason I think to actually invest in global equities is because, just to give you another perspective of what sort of diversification they offer. So over here, this chart over here, basically I charted all the unique Indian funds on the FSM platform, how they react to the Sensex index and how they react to, of course, your Indian 10-year government bonds. And what we realized that actually all your overseas fund of funds that's actually on the platform, which basically they invest in global equities, they have very low correlation again with the Indian equity market. And I think the key point to actually take away is that they don't just offer diversification, but they also offer you a new avenue for very profitable opportunities. And just think about what the best equity market returns were in 2020, and I think some indices would be at the top of the list, such as your Nasdaq 100 index or even your Chinese equity markets. These are some of the markets that have done really well, and I think if you had invested in these markets, you would not have only profited, but you will also have increased the level of diversification for your portfolio. And of course, there are many ways to actually think about diversification. One way we like to look at it is always through a football field diagram, right? I think it's a great way to start conversations. So how you can do it is to really structure your portfolio from a football manager perspective. For your attackers, for your midfielders, you want assets that have moderate to high correlation with global equity markets, because these are the players that will actually score you goals. Whereas on the other hand, for your defenders, for your goalkeeper, you definitely want something that's more defensive, something that's more lowly or negatively correlated with global equity markets. And of course, if you combine everything together, you should get a very diversified portfolio. And another thing is actually portfolio rebalancing. So if the idea is really to periodically sell winners and buy losers, right? and I think this is a concept that many of you should already know. So this is to ensure that portfolio risk does not veer too far away from your investor's preference. And at the end of the day, portfolio rebalancing has shown to actually demonstrate better risk-adjusted returns. And I'll show you in the two case studies. The first one is the US equities and bonds. Let's look at overseas for the beginning. So what we realized that is that, when you rebalance your portfolio, it ensures that actually your overall returns are actually better off in terms of risk-adjusted terms. I say risk-adjusted terms is because actually on an absolute return basis, your returns would be lower. But if you account for volatility, then of course, you'll be better off. It means that your portfolio is more efficient in terms of generating returns. So the other case study we look at is perhaps Indian equities and US equities. So this is what the results would have been if you had not rebalanced your portfolio. So a 50-50 allocation to Indian equities as well as US equities would have garnered you about close to 350% since investing in 1979, and this is in rupee terms. But if you had rebalanced your portfolio, your returns based on historical numbers would have been more than 500%. And I think this clearly shows the fact that rebalancing do help in overall returns over the long term. And of course, the last, I think, idea that, the last key to actually protect yourself from future black swan events is really to have a systematic investment plan in place. Because it's basically dollar cost averaging, and by doing so, you actually reduce the impact of market volatility because you're spreading your investments over a period of time rather than a lump sum investment. So I think the most important thing about this is that, you basically take away elements of market timing. You take away emotions out of the investment equation. You don't make stupid mistakes of selling at the lows and buying at the highs. And last but not least, I think it forces investors to actually think long term. So this plan is also, I think, very suited for investors who are new, who are just introducing them to investments, or and that they don't really have the knowledge or they don't have the capacity to actually monitor the investment regularly. So I think this is a great way for them to build their wealth. So the evidence of why systematic investment plan works, because if you look at the past, let's just take the worst economic event in history, the Great Depression. So so if you are invested in the market at its highest peak during the prior to the Great Depression, right, you would have only you only broke even probably 30 years later, 20 to 30 years later, right? Which is denoted by the black line over there. And you would have actually experienced a maximum drawdown of minus 86% during this period. But for example, if you had started your systematic investment plan during the peak as well, instead of putting your money in as a lump sum investment, you put it across a period of time, you realize that actually your maximum drawdown is not that low. So the blue shaded area is, of course, how much you've invested over time, and the red shaded area is your portfolio value over time, right? And you realize that you would actually have broke even just about 4 years later, in June 1935. You would have pretty much broke even. Another case study, the World War II event, same thing. You would have only broke even, let's say, about about 7 to 8 years later. But if you use a SIP plan, you would have broke even probably just 2 to 3 years later. So just to conclude this very short presentation, this short time that I have with you guys, I think what I've shown over the various keys is that they all can help to improve your portfolio, whether it's from a diversification perspective or whether it's from a long-term return perspective. And I think the important thing is to not to cherry pick one tool and just because one is probably more convenient for you and call it a day. And I think you have to use all three tools together because these tools are basically edges. By stacking all these edges together, it can help you increase the odds of investment success for you and your clients. And I think each tool has a specific purpose and it gives investors a specific edge. So I think diversification definitely helps you with the risk-adjusted portion. When you think about portfolio rebalancing, it allows for, in a way, buying low and selling high, because you are basically selling your winners and buying losers over the long term. And this actually also ensures that your portfolio risk is kept in line with your client's investment preference, whether they're moderate, aggressive, or even conservative investor. And lastly, I think a regular savings plans which is basically the systematic investment plan, it helps to create a better psychology management for your clients, because they did not invest their money lump sum, and that they're in this for a long haul. They know that they're in this for a long haul. The results show that if you're in this for the long haul, you're more likely to succeed. And I think most importantly, this will help to inculcate a long-term investment horizon, which I think is basically what's most important for investment success. Yeah, so I think for now I've come to the end of my presentation. I will have some time for one or two questions if there are any.
Are you able to see the question, Sean?
Wait, hold on. Wow,
I'll read it out to you.
Yeah.
Yeah.
While global diversification is great in reducing risk, in case of a black swan event, won't the correlations actually break down? Well, yes. As if there's a systematic global event, I would say that most equity markets across the world, their correlation numbers will basically be very, very correlated. Whether is it correlated to a degree of 1.0, 0.8, 0.5, which is why I think it's important for fixed income to be a part of your portfolio, even no matter how bullish you are right now because of the COVID recovery. I still believe that fixed income has still a place to play for your portfolio. Yeah, and which is why if you go back to the diagram, the football field diagram, you need to have all these fixed income segments. You need to have Indian bonds in your portfolio. You might also want to have some precious metals as well, because over a long period of time, precious metals basically have a correlation of zero with equity markets. Yeah. Can you elaborate on the point where you said rebalancing helps you to lock in profits to recycle into laggards? So, okay. So I would like to, again, use the example of the football field diagram, right? Imagine the football field diagram is basically how you allocate your monies. And you basically put, for example, 5% about 25% of portfolio in global equities, 25% of your portfolio in Indian equities, and maybe 50% of portfolio in fixed income, and perhaps precious metals. So let's just have this example where global equities did really well during this year, where they actually rose by 25%. Indian equities, on the other hand, only rose about 10%. And fixed income markets actually had a negative return of about 5%, right? So this is just an example. So by rebalancing, which is basically selling global equities at the end of the year, selling some of your Indian equities perhaps, and recycling these monies back into the fixed income markets, this is one way that you can actually rebalance your portfolio, assuming that you are a 50-50 balanced investor. Because the thing is, equity markets don't go up in a straight line. They go up, they go down, they go up, they go down. And therefore, I think by doing so, you're actually locking in some profits when they do well, and you recycle them into the ones that don't do well. Because at the end of the day, various asset classes work differently. They move in a different trajectory at all times. So when you do that, you lock in profits and you ensure that you are in position to actually make more money from the underperforming asset class. Yeah, so I think we have come to the time is running short, so I'll be passing my time on to Dipali. Yeah.
Thank you so much, Sean. It's been very, very insightful. Thank you.